Okay, so you traded the event. Now, the biggest way that you learn anything from these events is not just by trading it and thinking, that was a good day, or oh, that wasn't such a good day. It's going through a debrief, going through a clear structure on how you're going to reflect on the event, where the opportunities were, what opportunities you took, whether you could have improved on any of those opportunities that you took. It's not all about picking fault in things you've done, but understanding what's happened throughout the trade, throughout the event, that's then going to give you more opportunity to learn and more opportunity to spot trades going forward. So first up, I try and break it down, just get the main bits of info down so that when you come back and look at a chart, you've got the context there with you. So first up, policy change. Was it expected? Was it not? This was definitely unexpected. Also note down forecast changes. Now, in this instance, a change in forecast was not overly important because of the way policy changed. So whilst we did see improvements in the ECB's forecasts for inflation, for GDP, this was completely overtaken by the fact that asset purchases were reduced to 60 billion and for 9 months of an extension. Language-wise, equally, not a great deal either way. So use these tick boxes. It was both hawkish and dovish in a sense because of the fact it was neutral. We got neither. There were no clear signs. We had signs in the previous month about considering information come the December meeting, and that was all we got, and that was your hint. So the consideration forward into the December meeting. Next up, and this is where you actually start learning things. This is where you start finding out where your opportunities were. Was there another opportunity that you perhaps missed? What more could you be focusing on? And that's where you get down your chart and also why we got such a reaction. So you can see from the chart, we got a very, very strong reaction in the bund. Note down some of these things. The move in total was 125 ticks. That's a rather large move, bigger than any previous that we've seen, certainly in the first minute. And then we got a situation of consolidation, no secondary move lower, and then a move back up and a full retracement of the move. So you start questioning yourself, particularly around certain areas. What happened here that told you that perhaps we could be on for a reversal? What happened there that could have given you a trade? We all know what happened here on this first move down, these 125 ticks. What you don't always think about and don't always reflect on is if you missed this move or perhaps weren't ready for it, hadn't fully prepared for it, is there another trade? It's very, very easy if a large move happens to then become despondent, and in this area here you then end up taking no trades on when there are opportunities. There's range bound trade there. There are opportunities to take a few trades, waiting for levels, taking those trades on. Perhaps not taking the big move, not taking the 120 ticks, but you are still giving yourself opportunities, and this is a great way to reflect and see where you could be taking more trades on. Is there more in this for you than you might at first think? Because the obvious thing to think is one big move of 125 ticks, range bound trade of 40 ticks for the best part of an hour, and then nothing. And so you very quickly look back on these events and start thinking, well, if you're not in on this first move, there's nothing more to be done. Not entirely the case. So that's what you want to be noting down from charts. Also, big thing on these charts, what was the price action like in certain areas? What was the price action like here as we started to break upwards? How was this different to the price action here, where the market couldn't push on any higher? It couldn't get back into this little low volume area. So when you start considering those things, you'll then start noticing what exactly it is that allows you to buy the market here and stops you from buying it here. Likewise, what were we seeing down around about the 160.29 area? that eventually created a low. What was happening during these parts of the move when the volume was very, very high, and also when volume not so high? As we come off a second time down towards 160.09, was there anything that could allow you to buy here? These are the things you need to be noting down on your charts. So annotate your charts fully. Write down everything you were thinking at the time as well, because that is key information. That will help you very quickly establish whether the trade was there or whether you were fishing for a trade potentially. So get all of those things down, and also why exactly we did it, why exactly we got the move that we did. And I've got that a little bit lower down in terms of the key things to be noting down. This 60 billion change, that's the key one that you want to be noting. 60 billion change, that was what created the move. Other than that, everything else reasonably similar. Note also, the news on rates came 1 second before the news on asset purchases. Yes, 1 second is a tiny amount, but 1 second gives you just enough time to actually collect your thoughts. You notice that rates haven't changed. Yes, this was fully expected rates not to change, but it just allows you to sort of pause, see the next bit of the movement, and then expect that next time. You expect that you're going to get a slight pause before you get all the information. Finally, trade types. What trade type was it that you were looking for, and what trade type was it that was actually playable? In this example, it was a specified binary trade, in that there was a very specific number, very specific outcome that created a move. Other outcomes were not going to create a move. So if we had an unchanged or an extension for 6 months and 80 billion, then you would expect no movement. So it's what trade it was specifically that created the move and where the opportunities were there. Next up, you then, and this is the key bit, execution. How you execute these trades. Now in a moment I'll talk you through these 5 different types of trade as to what exactly that means and where exactly that allows you to get a trade on. This will help you out immensely for the drills coming up, because there will be a few different types of these trades, and understanding what then happens, not just in the first instance of the trade, but also how the market then trades afterwards, will allow you to start putting on more and more trades, because you're noticing the nuances of those trades, not merely, for example, hit and hold, which this one was, not merely you sell it and you wait and collect your money. There was something else that happened in there. So we'll go over, have a little explanation of these 5 trades you want to be thinking about. So hit and hold, a passive continuation, a breakout continuation, a fade and a reversal. So we've effectively got 3 different types of trade, and then the passive continuation and breakout continuation are the same type of trade. A fade and a reversal, equally the same type of trade. The hit and hold, slightly different. That's where you have to be very aggressive, as we saw in the video that has just gone by. So let's go and have a quick explanation of these types of trade. And here we go. So first up, we'll talk you through the hit and hold. Now in a hit and hold trade, this is what you use to trade a binary event, a specified binary event. You know exactly the information you want to see, and you trade that. You trade it very aggressively, as we just saw in the previous video, and then you expect an oversized move to start with that then continues. So say this move is to the upside, what you're likely to get is a move that surges very quickly, first 10 seconds, 30 seconds. You're then going to get still very aggressive moves, still very fast moves that then start to continue higher. So you might find that you get a pullback and some buying, and the market then continues to move in a more sort of flow way. The market will flow backwards and continue, flow backwards and continue. Whereas from a chart point of view, as we just saw, it looks as if it's gone in one straight line and just gone like that. Not really the case. So it's understanding what happens here, here, here that helps you stay in those trades. Visualize that pattern when you're taking these trades on, as opposed to just assuming that if you click, it's just going to keep going on side. What this allows you to do is when you do get in, say you get in here, it allows you to accept that the market is going to come back towards you. The market is going to make you feel under pressure and then continue. And this type of trade is all about conviction. It's all about understanding what the information was that you wanted to trade and then staying with it. We knew, as we saw on that previous video of the ECB, that a reduction in stimulus was going to create a large move to the downside in the bunds. Having conviction is what kept you in that trade and allows you to maximize that trade. So, if it's not a hit and hold trade, and perhaps something that requires a little bit more interpretation, or perhaps the first move isn't clear as to why, but you do feel that there's another trade in it, you then are looking for a continuation trade. And there's two ways of playing a continuation trade. You either have a passive continuation or a breakout continuation. Now both are essentially trying to find the same thing. With a passive continuation move, you'll get a move, for example lower, that perhaps has broken a level. Or perhaps you've seen some kind of price action around this area here that tells you want to sell it. So the passive continuation, as the market starts to come back up, you will have an order resting here, waiting to get filled, looking for the fill and then the move through the low. So your continuation, you're looking for a move through this initial low, but you're waiting for the move. You're waiting with orders resting in the market to get filled and take you through the low. Downside of this trade, the market may not come all the way back to where you believe that you can get filled, therefore leaving you with no position as the market comes off and then breaks lower. So that's your passive version. Now with a breakout continuation, you're not thinking about the previous areas to get in, you're not waiting resting orders. What you're looking for is the break lower, same level that we've broken, get the pullback, and perhaps we don't reach the level, and then we start coming back off, and you're looking then to sell it as the speed increases as we go through the low. So your aim is to sell it just before or at the low, looking for that break lower. It's a slightly higher risk trade in the sense that the market could dip below and then bounce straight back. But the idea behind this is you're not waiting for a passive entry higher up that doesn't come, and you're using price action. And this is where debriefing on your price action, what exactly you saw, is very, very crucial. Video your screens as well is highly recommended. That way you can see exactly what happens and start recognizing those patterns. So there's your two parts of continuation. You have your passive continuation and then your breakout continuation. Two different ways of effectively playing the same trade. And the key to this type of trade is understanding that this move does have more to it. Potentially, this is a technical break. That the market has a technical setup, perhaps it's positioned in a certain way that would make a continuation much more likely. And that way, you can then start paying these continuation trades from either way. Looking for the news to have helped the technical setup play out, and then the technical setup to actually play itself through. All right, so if we're not going to hit and hold, we're not going to play a continuation trade, what are we going to be doing? We're going to be looking for either a fade or a reversal. Now there is quite a clear distinction between the difference between a fade and a reversal. First up, let's have a look at a fade. Now the idea of a fade trade is that you will have a very clear idea of how far whichever market it is that you're trading is deemed as too far, perhaps, or you would deem as a long way for such information. So if you get a piece of information that you believe is not that market moving, or perhaps shouldn't create a move so large, and you get a very fast drop, the aim is, as you get the crescendo in volume, so you get the volume really spiking down into these lows, that's where you're looking to have a go at buying the market for the fast move back up. Now the danger with this trade is where you have your stop. You're not often buying it on a level, you're often buying it just purely based on price action, making it quite a difficult trade to know where your stop is. Ultimately, if you're buying it, your stop has at least got to be below that first low that it makes. And it could be a case that as the market comes off, you buy it here, the market then makes a low and then starts to bounce. And it's only once the market starts to come back up that you know where your stop is. But how far it is from where you buy to where the low is, you don't know as you're taking on that fade. So it is very much a case of it's a trade based purely on your observation of price action, how the market moves, where that crescendo volume is, and can you get in fast enough to take the quick bounce back up. Now this is slightly different from a reversal trade. A reversal trade will look a lot more at structure, at a way of giving yourself an in on the trade, rather than just trying to not guess but use price action purely to call a low. Now a reversal trade could work in a couple of different ways. Say we have a level. Market moves lower, bounces back up, and then holds the level and starts to continue higher. Your reversal trade could work whereby you don't believe that the information you have received is enough to create a continuation or a hit and hold trade. So you're then looking for the market's turnaround. You've seen this level break, and you've then seen, as we've come higher, we've held the level again. So the level broke perhaps on the initial information, but as soon as we get back above it, the level comes back into play and holds. This is where you can have a go at buying the level, you can have a stop below the previous low, or even you can have a stop below the level and then buying it for the move back up, potentially for a full retracement of the move. The other alternative, even without a level, if you get some kind of bounce structure that helps you out, potentially you get a flag in the opposite direction. This is where you've seen the fast move lower, you've seen that volume peak, so volume's gone much, much higher. You then effectively create a flag, and it's on the break of that flag that you can have a go at buying it. So it's all about using a structure, using some kind of technical pattern that allows you in on a reversal trade as opposed to a fade trade, which has a much, much more aggressive nature to it and very price action based trade. So watch back any videos that you've made, have a look at how these things can play out. Now if we go back and have a look at our debrief, you can see that there's a couple of opportunities for both reversals and continuation trades. Now you'll remember in the video we mentioned 160.72. This bounce here came to 70, and this is where your passive continuation trade would not have given you an opportunity. We did not get filled if you were waiting at 72 and then the market starts to come back off. We sit in a range. This time, however, you do get the fill. Yes, it pushes up towards 80s, and yes, there is a possibility you could have got stopped out depending upon where you put your stops. So again, this is something to go back over. In a much more volatile environment, do you have to widen your stops a little bit before taking on a trade? But in both cases, if you were paying a passive continuation, you did not get the full move lower for the continuation. So in either case, you are likely to have got stopped out, if not taken a smaller profit or a trailing stop. So that was your continuation trade or passive continuation trade that we saw. Very limited opportunity for a breakout continuation trade. Really, that's where you'd be looking to sell through this previous low. We didn't get down there, so there's no breakout continuation. This was the hit and hold. We'll call it an H&H. And then also, you got the reversal trade. As we started breaking through 72 and 80 area, you then got the move back higher. So we've had three different trades here. So hit and hold, a passive continuation that didn't play out in the end, but it was still available, and then also the reversal trade higher. So go back over each of those trades, have a look at what was going on there. What were you thinking at the time as well? Did you recognize the chance of that passive continuation? Did you recognize the opportunity of a reversal trade as well? So they're the kind of things you want to be focusing on in your debrief. Every central bank should have a debrief following a very similar format. That way, you consistently go over things in the same way, and by using the same logical patterns that you review events with, gets them to stick clearer. It also allows you to get a little bit more thoughtful about what you can do in future, on future moves. By noting these things down, by noting down the facts of how things changed, just stimulates the brain to start thinking about other trades that are available, other trades that perhaps you wouldn't have thought about previously. So that's the importance of a debrief, and also an explanation of the different ways you can execute trades based on central bank events, or any macro event for that matter. Any kind of news event will have the similar type of execution on all trades. All right, let's move on. We're going to move on and have a look at some drills. And this is where you can start implementing some of those ideas, implementing some of those trades.